Hello everyone, welcome to part 2 of chapter 2's lecture. In part 1 we went through the concepts and the different topics covered here in chapter 2, financial statements, taxes, and cash flow. And then what we will be covering here today will be some quantitative problems that are very similar to what you will see on your homework and also on exam 1, which includes chapter 2. So let's work. The first problem that we're going to look at is located at the bottom of your chapter 2 outline, and it deals with cash flows. So here we are provided, first of all, the cash flow equation. So since this is an online course and you are advised to use your resources that are available, you do not need to memorize any of these particular cash flow equations. However, it is important that you understand what these cash flow equations are actually showcasing. So what we have first is table 2.6, which includes the different cash flow equations. And then the question asks, based on the balance sheet and the income statement above, calculate cash flow from assets, cash flow to creditors, and cash flow to stockholders. So what we are doing here is trying to identify over the period of 2018 what types of cash flows came into the company and then where did those cash flows go. So what we have is our cash flow from asset, or our cash flow identity, which states that cash flow from assets is equal to cash flow to creditors plus cash flow to stockholders. That is something that is always true, just like the balance sheet identity, where the balance sheet always balances. These cash flows will always balance. So what types of cash flows did our assets generate? And then with those cash flows, where did we distribute them? To creditors or stockholders, those that funded the asset purchases. So the first thing that we will be doing is calculating cash flow from assets. If we look at our equation sheet, we see that cash flow from assets is equal to operating cash flow. So what types of cash flows did your operations bring in? Net capital spending. What types of cash flows did you spend or receive based on fixed assets purchases or sales? And then change in net working capital. What types of cash flows occurred from an increase in current assets relative to current liabilities or a decrease in current assets relative to current liabilities. So the first thing that we are going to look at is operating cash flow. Operating cash flow is equal to your earnings before interest and taxes plus depreciation minus taxes. Hopefully you realize that all of these values come from the income statement. So what we'll do is we'll come over here to the 2018 income statement and identify earnings before interest and taxes. We will add back in depreciation, and then we will subtract our tax balance. So your operating cash flow for this U.S. corporation for 2018 is equal to EBIT, which is 694, plus depreciation, which is 65, minus your taxes of 131, and what we get is an operating cash flow of $628. So what that showcases is that this company generated cash flows from their operations of $628. As mentioned in part 1 of the lecture, if this value is a negative value, that's oftentimes a sign of trouble for a company. It should be a positive value, but this company's cash flows from operations equaled $628. Now, the next step then is to calculate net capital spending. So to help generate this $628 of cash from operations, did the company have to make additional spending or additional investments in their fixed assets? That's what net capital spending showcases. So if we go back up to our equation sheet, we see that net capital spending is ending net fixed assets minus your beginning net fixed assets, and then we add back in depreciation, since depreciation is a non-cash expense and it is something that is deducted on your balance sheet year over year. So the ending and beginning just refers to the time period that you're analyzing. Here we're analyzing 2018, so the beginning would be 2017, the year previously, to the ending of this time period, which would be the 2018 balance sheet. So what we do is we take the ending net fixed assets, which is $1,709, from the balance sheet. We subtract the beginning fixed assets of $1,644, and then we add back in that depreciation expense of $65 taken from over there on the income statement. So our net capital spending, as I mentioned, is your ending fixed assets, $1,709, minus your beginning, $1,644, and then we add back in our depreciation of $65, and what we get is a net capital spending of $130. So the way that you can understand this is that the company's operations generated $628 of cash inflow, But to help generate that $628 of cash inflow, they also had to spend an additional $130 on fixed asset purchases. If it were a negative value, that would just signify that they actually sold off more of their fixed assets over that time period, which would be a cash inflow for the company, as opposed to this positive value, which showcases a cash outflow, a purchase of more fixed assets. Then the third part of our cash flow from assets equation is the change in net working capital. So if we look at our equation here, change in net working capital is equal to ending net working capital minus beginning net working capital. Net working capital is not a value that is explicitly showcased on the balance sheet. Instead, we first have to calculate it. So we have to think back to the first part of Chapter 2, Lecture 1, which said that net working capital is equal to current assets minus current liabilities. So the ending net working capital would simply be the 2018 current assets minus current liabilities, and the beginning net working capital would be the 2017 current assets minus current liabilities. So first, let's calculate the ending net working capital. So as I mentioned, it would be the 2018 current assets minus current liabilities. Current assets in 2018 are $1,464. Current liabilities are $389. We take that difference, and we get a net working capital value of $1,075. Then we do the same for our beginning net working capital, which would be the 2017 current assets minus current liabilities, so $1,112 minus $428. $1,112 minus $428, and we would have a beginning net working capital value of, or total of, $684. So we can see that their net working capital from 2017, their beginning to end, went up. So their current assets relative to their current liabilities increased, which would signify a purchase of current assets, which would end up decreasing our overall cash flows for cash flow from assets. So that next step is to calculate this change. So the change in net working capital is the ending net working capital, which is $1,075, minus the beginning of $684, and we get a change in net working capital that is equal to $391. So once again, their operations brought in a cash inflow of $628, but to help generate that $628 cash inflow, they had to spend an additional $391 on current assets relative to their current liabilities. So our last step then is to go back up to our equation and look at our cash flow from assets in totality, which is operating cash flow. So cash flow from assets, which is equal to operating cash flow minus net capital spending minus change in net working capital. So we take 628 minus 130 minus 391, and we get a cash flow from assets equal to $107. So their assets generated a cash inflow of $107. Now, it is not uncommon for companies, especially growing companies, to have a negative cash flow from assets. All that would signify is that they're spending more on their fixed assets than what their current operations are currently generating, right? So with this positive value, their operations actually brought in more than what they spent on their asset base, fixed and current, over this particular time period. So their cash flow from assets is equal to 107. That's the left-hand side of our balance sheet of our cash flow identity up here at the top. And so now what we're going to do is focus on the right-hand side. So their operations, their cash flow from assets brought in $107. Where did that $107 go to in terms of those that funded those asset purchases? So they fund their assets with debt or equity. So did the cash flows go to their creditors, or did those cash flows go to their stockholders? So the first thing that we will do is look at cash flow to creditors. Looking at our equations, cash flow to creditors is equal to interest paid minus net new borrowing. So this combines, once again, the income statement and the balance sheet. Interest paid here is $70, and then net new borrowing focuses on your long-term debt. So creditors our creditors are termed as our long-term debt. So we're looking at the change in long-term debt balances from 2017 to 2018. You can obviously see that it went up from 408 to 454. So they did borrow more over this time period, and we want to know what the total cash flow was from their creditors. So what we do is we calculate cash flow to creditors, which, going back to the equation, is interest paid, which is 70 from the income statement, minus net new borrowing. So it would be ending long-term debt, so 454, minus beginning long-term debt of 408. And what you can see here then is that they actually borrowed an additional $46 from creditors. So they paid out 70, but borrowed 46 more, so their net cash flow to creditors is $24. So overall, they actually paid out a total of $24 to creditors, even though their interest amount was 70. They paid out 70, but over the course of the year, they actually borrowed an extra 46. So their total cash flow to creditors is 24. Now, you should be able to calculate cash flow to stockholders without even doing any calculations because of the fact of the cash flow identity, where cash flow from assets equals cash flow to creditors plus cash flow to stockholders. So we do know that this cash flow to stockholders must equal, what is that, 63? So now what we can do is actually prove this by calculating cash flow to stockholders using the equations. You always want to verify that your other numbers are indeed correct. So cash flow to stockholders, going back up to our equation sheet, is dividends paid minus net new equity raised. Dividends paid comes from our income statement, so 123. Net new equity raised, we are only focused, and please pay close attention to this, we are only focused on common stock and paid in surplus accounts. So we are not concerned with changes in retained earnings because we are only focusing on cash flow that is raised in the equity markets. Retained earnings are cash flows that are plowed back into the company from their net income from the previous period. We only are concerned with new cash flows that were raised in the equity markets, not changes in our stockholders' equity balance based on cash flows that retained earnings that we have plowed back into the company. So cash flow from stockholders is dividends paid minus net new equity. Dividends paid, as we mentioned, is equal to 123. And then we subtract net new equity. In this case, they've actually separated the common stock and paid in surplus from retained earnings. So we can see that they did raise an extra $40 over the course of the year in terms of new equity issuance. And so what we have is ending, which is 640, minus beginning, which is 600. So as I mentioned, they brought in an additional $40. So we do 123 minus 40, and we end up getting a value of $83. Sorry, I think I said 63 earlier, the $83. So now what you always want to do is you do want to check to make sure that, well, one thing that I should showcase here with cash flow to stockholders, if it's not separated like it is here, where they've separated common stock and paid in surplus and retained earnings, this is how you would calculate cash flow to stockholders. It's still dividends paid, but then you would take the ending stockholders' equity, which is $2,330, and then you subtract the addition to retained earnings because you don't want to take that into consideration. So you would subtract that 330 or 370 over here from the income statement minus the beginning balance, the beginning stockholders' equity of $1,920. And you would still get the same value of $83 paid out to shareholders. So in totality, their net cash flow to stockholders was $83. But continuing on, just to verify that our problems are indeed correct, what we will want to do is verify this by looking at this cash flow identity up here at the top and make sure that it does indeed balance. Cash flow from assets, 107. Does that actually equal cash flow to creditors? Let me just highlight our final values here. Cash flow to creditors, which is 24, plus cash flow to stockholders, which is 83. This does indeed balance. So these are the different cash flows. So once again, just kind of explaining what's happening here. Their cash flow from assets, their assets generated a total cash flow of $107. And with that $107, they paid out $24 to their creditors and paid out $83 to their stockholders. So what we will now be working on are some more quantitative problems. These can be found on the Chapter 2 Extra Practice document located on Blackboard, and that's what we will turn our attention to now. Okay, so now what I'm looking at is the Chapter 2 Extra Practice document located on Blackboard, and we'll work through some of these to provide some additional guidance, as I mentioned, for the Chapter 2 homework and for the first exam. So number 1 talks about a company having net working capital of $1,672, If all the current assets were liquidated, the company would receive $5,611. What are the company's current liabilities? So once again, we have to remember what net working capital is. Net working capital is equal to current assets minus current liabilities. They have told us that the net working capital is $1,672. And we know that their current assets are $5,611, as mentioned in the first part of Chapter 2's Lecture 1 video. Market values and book values do differ sometimes, but oftentimes with current assets, those are relatively close. So this 5,611 is what we are using as our current asset value, and then we are subtracting the unknown current liability. When you solve for current liabilities, you will see that the current liabilities in this scenario are $3,939. So not a very complex problem. More so just checking and assessing, do we understand what net working capital is? Moving on to number 2. So Wins Incorporated has current assets of $4,000, net fixed assets of $13,500, that should say. So let me just correct that. So $13,500, current liabilities of $3,500, and long-term debt of $5,900. What is the value of the shareholders' equity account for this firm? So in order to find shareholders' equity, what we're going to have to do is construct a very basic balance sheet. Okay, so we're going to construct a very basic balance sheet and utilize our understanding that the balance sheet must always balance, since we do have all of the other accounts outside of the shareholders' equity. So what we're going to do is, since I don't have too much room here, you may want to use a separate sheet of paper if you're following along. Let's create a very basic balance sheet where we have our assets on the left-hand side, and we have our liabilities and stockholders' equity on the right-hand side. They have told us, and we know that assets are broken down into current and fixed. They have told us that we have current assets of $4,000, and they have told us that we have fixed assets of $13,500. So what we have is total assets equal to $17,500. And then they have told us that we have current liabilities that are $3,500. And they have told us that we have long-term liabilities of $5,900. Once again, we know that liabilities are broken down into current and long-term. And then they want to know what is the value of the shareholders' equity. So we know that total liabilities plus stockholders' equity must equal total assets based on the balance sheet identity, right? So we know that it must equal $17,500. So we can actually say that total liabilities and stockholders' equity must equal $17,500 based on the balance sheet identity. We also know then that our right-hand side of our balance sheet, liabilities and stockholders' equity, is broken down into current liabilities, long-term liabilities for our liabilities portion, and then we will have our stockholders' equity balance to sum together for our total liabilities and stockholders' equity. So to calculate owner's equity here, what we are going to do is take the total of $17,500 minus all of our liabilities, which is $3,500 minus $5,900, and we can solve for our owner's equity balance equal to $8,100. So what this problem is assessing is your understanding of what a basic balance sheet is and understanding that assets must always equal liabilities and stockholders' equity. Then for Part B, similar to Part 1, they want to know how much is net working capital. Once again, net working capital is equal to current assets minus current liabilities. We can see in our basic balance sheet, current assets are $4,000, current liabilities are $3,500. So when I plug these values in, I will get a net working capital equal to $500. So this problem, as I mentioned, assessing your understanding, do you understand how a balance sheet, a basic balance sheet is constructed, what you can pull away from that, in particular looking at net working capital here and understanding that the balance sheet must always balance. Number 3, Shaq's Bakery has sales of this amount, $487,000, with cost of $283,000. Interest expense is $26,000 and depreciation is $28,000. Tax rate is 21%. What is net income? So yes, I did talk about how this course or this chapter is not focused on primarily the construction of these different financial statements, but it is important to understand what the different layouts are so that when analyzing these financial statements, you can pull out different portions or different accounts of interest, and that will be something that we'll discuss again more in Chapter 3 when we actually do a ratio analysis from these financial statements. So this is a basic balance sheet construction where we have sales minus costs and the different expenses to get down to our bottom line, which is net income. So we start off with our top line figure, which is sales or revenues, and they have sales of $487,000, and then we subtract all of our costs. So you can have your cost of goods sold, your SG&A, your selling, general, and administrative. Here they just group them all together and list it as costs. So we have an expense of $263,000. Now, this is something extra for those of you that do evaluate or look at these different financial statements. Oftentimes, you will see a value or an acronym called EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So it is simply sales minus cost. So you may have a line break here that will showcase what the sales minus cost is, which is your EBITDA value, and you get this value of $224,000. Now, if you were to skip that, it's not going to impact anything. It's just one additional piece of information. For those of you that are finance majors, you will see the term EBITDA in future courses. Next up, the EBITDA kind of showcases what comes out next. In this case, it's going to be your depreciation expense. Your depreciation expense is given at $28,000. And then you get your EBIT. This is your operating income. So EBIT is known as your operating income. This is something that you need to know. So EBIT is here $196,000. And I'm just going to continue over here since I'm running out of space. The next thing that comes out on your operating or on your income statement is your interest expense. Your interest expense once again is given at $26,000. And so then what you get to is your taxable income. And your taxable income then is $170,000. You have to pay taxes on that taxable income. We talked about in earlier in this chapter that corporations are now taxed at a flat tax rate of 21%. So we will multiply this by 21%, and we will deduct $35,700, and you get to a bottom line value of net income of $134,300. So again, not terribly difficult in terms of the actual computation work, but it is assessing, do you understand what an income statement looks like and what the main line items are. So numbers 4, 5, and 6 go back to our cash flow problems. So these are a little bit more straightforward than the one that we've worked on previously at the end of the Chapter 2 outline. Here, 2018 balance sheet, Sugarpova's tennis shop showed long-term debt of $1.95 million. 2019 balance sheet showed long-term debt of $2.28 million. So you can see it has actually gone up, so that means that they have borrowed more. And then in 2019, they have an interest expense of $235,000. What was their total cash flow to creditors? Well, cash flow to creditors is equal to your interest paid minus net new borrowing. So the interest paid is equal to $235,000. And then to figure out their net new borrowing, it would end up being your long-term debt for 2019, which is $2.28 million, minus your long-term debt in 2018, the beginning period, which is $1.95 million. And you end up getting a cash flow to creditors that is equal to negative $95,000. So what this is showcasing is that they actually paid out, or that they actually borrowed more than what they paid out to their creditors. So this could be a growing company that is looking for funding for their assets. All this is showcasing is that they borrowed more than what they actually paid out. That's why we have a negative value there for our cash flow to creditors. So they have borrowed more than what they actually paid out over that particular time period. 2018, analyzing the same company. Now we are looking at a common stock account of $670,000 in common stock, $4.1 million in additional paid in surplus. 2019 is $825,000 and $4.4 in those same two accounts. They paid out $565 in cash dividends. What was the cash flow to stockholders? So once again, cash flow to stockholders is equal to dividends paid minus net new equity. And once again, we are focused on new equity raised in the capital markets, so we are only focused on common stock and additional paid in surplus. If you've never heard additional paid in surplus is basically when an investor purchases a company's shares that exceed the par value. So this is only applicable on purchases of shares directly from the company. Oftentimes what the company will do is they'll list their par value at an extremely low amount, such as 0 or 1 cent. And what they do is they do this to avoid any liabilities to the stockholders if the stock price were to go down. So that additional paid in surplus is what an investor pays above the par value for the stock, and it's only applicable when investors purchase stocks directly from the company. So it doesn't happen out on the secondary market. That's not something that affects the additional paid in surplus account. So here, for cash flow to stockholders, getting back to the problem, dividends paid was provided at $565,000. So they paid out $565,000 in total for dividends paid, and then what we need to do is calculate the net new equity raised. So the ending equity balance would be the 2019 values, so $825,000 in common stock, plus the $4.4 million in additional paid in surplus, minus the 2018 values. So the 2018 values are $670,000 in common stock, minus the additional paid in surplus of $4.1 million. And what we would end up getting then is a total cash flow to stockholders when you do all of this math here. So their equity balance in 2019 is $5,225,000, and you guys can verify this. And then in 2018, it would have been $4,770,000. So you can see that they did raise new capital in the equity markets from 2018 to 2019. They paid out $565,000 though, so their total cash flow to stockholders here is $110,000. So they actually paid out an additional $110,000 in surplus of what they actually raised in the form of new equity over the course of this time period. Number 6. So given this information in 4 and 5, let's suppose that we also know the firm's net capital spending is $1,250,000, and that it also reduced its net working capital investment by $45,000, meaning that their net working capital value actually went down, meaning that they sold off more current assets relative to their current liabilities. And if they sold it off, that would be an actually cash inflow, something to think about as we go through this problem. And we want to know what was the firm's 2019 operating cash flow, and the hint is to use the cash flow identity to first find cash flow from assets. So we know that cash flow from assets is equal to cash flow to creditors plus cash flow to stockholders. We've already calculated cash flow to creditors, and we calculated cash flow to stockholders, so it's very easy to solve for cash flow from assets. It would be equal to negative $95,000 from problem 4, plus $110,000 from problem 5. There's a total cash flow from assets equal to $15,000. Now, we also know that cash flow from assets is equal to operating cash flow minus net capital spending minus change in net working capital. So they've given these values here in the problem. They say that, well, we just saw for cash flow from assets, they gave us net capital spending, and then they reduced their net working capital investment by $45,000. So it's actually a negative value there for change in net working capital, which is ending net working capital minus beginning. So if they reduced it, the net working capital in the end is actually smaller than the beginning, showcasing that's a negative value. So operating cash flow is what we are solving for. We just solved for cash flow from assets. Operating cash flow is what we are solving for. Net capital spending here is $1,250,000, and then minus this change in net working capital, which, as I mentioned quite a few times, is a negative value, since they did indeed reduce it, which would showcase a cash inflow from this change in net working capital. That's why we get the negative minus the negative for the positive. So you get $15,000 as your cash flow from assets equals operating cash flow minus $1,205,000. add $1,205,000 to both sides, and we get an operating cash flow of $1,220,000. So, problems 4, 5, and 6. Really what they are doing is assessing, do you understand the different cash flow values, and can you calculate them given different pieces of information? Hopefully we're starting to get a better understanding of what each cash flow signifies, when it's positive versus a negative value. Is it a cash inflow for the company, cash outflow? And we understand that the cash flow from assets are what the total or the net cash flow from the assets, which include your operations, in addition to any spending, your net capital spending, or your fixed assets, or spending on your current assets, which is that change in net working capital. And we get this cash flow from assets, and then where did that cash flow come, or where did it go? Did it go to creditors? Did it go to stockholders? And then if it's negative values, where did we raise the funds from? So number 7, very similar to the problem that we did at the end of the Chapter 2 handout. I think it might be best here to give you the answers to this and then let you work through it on your own, and let me know if you have any questions about this particular problem. One thing that I do want to point out is notice that stockholders' equity is not broken down into common stock and paid in surplus. It actually has just stockholders' equity. So what we have here is common stock. We have paid or additional paid in surplus, and retained earnings. So what's important is go back to the beginning of this video and look at the second way that I solved for cash flow to stockholders. You're going to want to make sure that you do not include this $3,245.50. So actually, let's just work through that particular portion of the problem, and I'll give you the rest of the answers here for problem 7. So looking at cash flow to stockholders, this is the only one that we're focusing on here, and I'll give you the answers for the other ones. Because you can see here in the problem, they want us to calculate cash flow from assets, cash flow to creditors, and cash flow to stockholders. Here, we'll just start off. Cash flow from assets in this problem is equal to a negative $1,627.50. All that is showcasing is that they actually spent more on their assets, fixed and current, relative to what their operations actually brought in. So now we try to identify where did they actually raise those funds to purchase those assets. So when you calculate cash flow to creditors, you actually get a negative value of $4,834. And what I would like for you to do here is to work through the equations that are provided on the handout and see if you can get these different values, understanding that cash flow from assets is operating cash flow, net capital spending, change in net working capital. You should get this as the net cash flow from assets. You should get this as the net cash flow to creditors. And then I'll showcase how to solve for cash flow to stockholders, since the format in this problem is slightly different from the one at the beginning of today's video. So cash flow to stockholders, if you remember, is equal to dividends paid minus net new equity. And again, we are focused on new equity raised in the capital markets, so we do not want to include any retained earnings. So we look at dividends paid of $2,324. And then net new equity, their ending equity was $78,726. But that also includes whatever they added in the form of retained earnings, this $3,245.50. So we're actually going to want to deduct that from that ending balance. And then we subtract the beginning stockholders' equity balance. And we don't have to worry about taking out any retained earnings there, because we're just looking at this time period for 2018. We just want to know from 2017 to 2018, how much new equity did they raise? We don't care what portion of that $76,363 is retained earnings. We're only concerned with the increase from one year to the next and what portion of that increase was from retained earnings. So we end up getting a cash flow to stockholders here that is equal to $3,206.50. So kind of summing up this problem, hopefully you do check your cash flow from assets and cash flow to creditors to verify those values, is that to kind of assess what's going on here, they actually spent more on their fixed assets and their current assets in comparison to what their operations were bringing in. Where did they receive that funding? They received that funding from their creditors, since they borrowed more than what they actually paid out, and then they actually paid out more than what they brought in terms of new equity in the form of their stockholders. So please work through that problem and check to see that you get those same values. And if you do have any questions about any of those, do not hesitate to contact me. Okay, so looking at problem number 8 here, we have Pompelli Incorporated, has sales of $48,000, cost of $22,200, depreciation of that, interest, tax rate is 21%. They want to know what is the operating cash flow. So the first thing you need to know is what is operating cash flow. That's one of our cash flows. It is equal to EBIT plus depreciation minus taxes. Hopefully you see that these are all from the income statement, so what we're going to have to do is create a very basic income statement. So once again, I'm going to actually work this one up here at the top. Start off with sales, $48,000. Then we take out our expenses, our costs. So you have your cost of goods sold, your selling, general, and administrative expenses, all those different costs of your operations. In this case, they group them all together. So we have costs of $22,200. Once again, you can make a line break here and have an EBITDA value, earnings before interest, taxes, depreciation, and amortization, which would be $25,800. Then we take out depreciation. Depreciation expense is $2,050. And we get to our EBIT, which is your operating income. That's hence how we get operating cash flow. Your EBIT then is $23,750. Then what we would do is deduct our interest expense. Our interest expense is $1,800. We get to our taxable income. Our taxable income then is $21,950. We pay taxes at 21%, and we end up getting tax expense of $4,609.50, and we get down to net income, which is equal to $17,340.50. So you actually didn't have to go all the way down to net income, since we did calculate our tax expense there for that would give us all the information necessary for operating cash flow. So we go ahead and just find the different values that we're looking for. EBIT, which is $23,750. We add back in depreciation of $2,050, and then we subtract taxes of $4,609.50, and you end up getting an operating cash flow that is equal to $21,190.50. So again, assessing, do you understand what an income statement looks like, and can you pull information from that income statement in order to solve for a particular cash flow? Moving on to number 9. So what we have here is Boyer Driving School 2018 balance sheet has net fixed assets of that amount. 2019 it jumps up to 3.5. Income statement showed depreciation of $328. What was their net capital spending? So over this time period for 2019, did they spend more on their fixed assets, or did they sell off more of their fixed assets? So a positive value would signify that they spent more. A negative value would signify that they sold off more over this time period. So net capital spending is equal to net fixed assets at the end minus net fixed assets at the beginning plus depreciation. So we have net fixed assets at the end of $3.5 million minus net fixed assets at the beginning of $2.7 million. So obviously you can see that they did spend some on their fixed assets over this time period, or was it all represented, or is this all depreciation value? So we add back in depreciation there of $328,000. Sorry, I shouldn't say is it all depreciation. We want to add that back in since depreciation was already taken out for both for that net fixed assets at the end. So we end up getting a net capital spending here of $1,128,000. So whatever this company generated in terms of their operating cash flow, they end up spending an additional $1 million plus on fixed assets to help generate that cash flow. Once again, positive value signifies that they spent more on their fixed assets over that time period. A negative value, meaning that their beginning fixed assets is greater than their ending would mean that they sold off more of their fixed assets, signifying a cash inflow. And then last up here, number 10, we have current assets for this company and current liabilities for 2018. Same for 2019. What was the company's change in net working capital? I know it's kind of repetitive. Net working capital is current assets minus current liabilities. Hopefully after doing enough of these, this will all come second nature and you won't really have to think about it too much as you go through your homework or your quiz. Before we can calculate a change, we need to calculate the ending net working capital and the beginning net working capital. So end would be taking 2019 minus 2019 values. So we have 2019 current assets of $5,180. We have 2019 current liabilities of $2,190. We take that difference. So $5,180 minus 2,000. Sorry. It would be the 2,830. So I just got my numbers fixed up. So 2019 values are 5,180 for current assets, 2,830 for current liabilities. So I subtract that 2,830, and I get an ending net working capital value that is equal to. Sorry, let me check this real fast. We get an ending net working capital value that is equal to 2,350. And then we need to do the same thing for our beginning net working capital. Our beginning net working capital is current assets of 4,630 minus our current liabilities of 2,190. We end up getting a value of, whoops. So 4,630 minus 2,190 of 2,440. And so our change in net working capital is equal to end net working capital minus beginning net working capital. And we end up getting a value that is equal to 2,350 minus 2,440, which would give us a value that is equal to negative $90. So what this is showcasing with a negative value and their net working capital actually decreasing is that they actually sold off more of their current assets relative to their current liabilities over the course of this time period. So that negative value actually showcases a cash inflow for the company over this time period. So I apologize with my speed there on that last problem. Had some of my numbers backed up on my handout, but hopefully you all were able to follow along. So that concludes part 2 of our chapter 2 discussion. Hopefully this provided some additional guidance on the chapter 2 material and provided a little bit of an extra context on some of the conceptual material as we work through these problems, and you were able to apply some of the concepts that we discussed here in the second chapter. So be sure to complete your chapter 2 homework. If you have any questions about anything, don't hesitate to reach out, and I will talk to you all soon. Have a great day.